Hi, I am Roy Bohannon, and this is my video presentation for managerial accounting. I have chosen topic 2, and so I will be summarizing each chapter we have covered so far and explain some differences in focus between Unit 1 and 2. Chapter 14 discusses managerial accounting concepts and principles. It starts with the purpose and nature of managerial accounting. The purpose, simply put, is planning and controlling. Planning is the process of setting goals and then making plans to achieve those goals. And control is the process of monitoring planning decisions and evaluating an organization's activities and its employees. Another important concept is classifying costs as fixed or variable, direct or indirect, product or period, to enable understanding of cost patterns and analyze performances. We also learned that merchandising, manufacturing, and service companies include different information on their balance sheets and income statements, particularly in regards to inventories and cost of goods sold. Two basic types of cost accounting systems are job order costing and process costing. Chapter 15 covers job order costing. Job order production is the production of specialized or unique products prompted by a customer's request that have low production volume and are highly flexible in their creation. In this type of production, costs are tied directly to each job or job lot that incurs the cost. Direct materials and direct labor are easy to account for and assigned to specific jobs by use of materials requisitions and timesheets. Overhead, which consists of indirect materials and labor, is based on a predetermined overhead rate, generally figured by direct labor hours or machine hours. Job cost sheets for jobs in process, finished goods, and jobs sold make up subsidiary records controlled by general ledger accounts. This is also helpful in determining a price for services. In contrast to job order costing, Chapter 16 discusses process costing, which is used in process operations where the products are being mass-produced with little to no variation in a continuous flow of sequential operations. Direct materials, direct labor, and overhead are combined in the operation, but instead of the cost object being a single job or job lot, the cost object is the process. Process costing accounts for equivalent units of production, which is the measure of the number of products that could have been completed given the measure of costs and processes incurred in a period. A process cost summary reports on the activities of a production process or department for a period. The report helps managers to control their departments and evaluate performances, as well as provide cost information for financial statements. Chapter 17 is about activity-based costing and begins by exploring 3 alternative methods of overhead allocation: plant-wide overhead rate method, departmental overhead rate method, and activity-based costing method. The plant-wide method combines all overhead costs into a single rate, usually based on direct labor hours, machine hours, or direct labor costs. Whereas the departmental method traces overhead costs based on departmental function. Activity-based costing links costs to activities and assigns overhead based on how much each activity is required for a product. Similar activities are formed into cost pools and then assigned to products in proportion to the amount of activity required to produce them. The 4 types of activities that incur costs are unit-level activities, batch-level activities, product-level activities, and facility-level activities. There are advantages and disadvantages to each method explored in this chapter. Chapter 18 covers cost behavior and cost volume profit analysis. Cost behavior is identified by the amount of cost change in relation to the change in volume activity within a relevant range. Costs are defined as fixed if they remain constant to changes in volume, or variable if they change in direct proportion to volume. Mixed costs will have both fixed and variable components. There are also stepwise costs, which reflect a step pattern in costs, and curvilinear costs, which increase at a non-constant rate as volume increases. Cost volume profit can be used to predict what could happen if there were changes in sales volume, selling prices, variable costs, or fixed costs. Also covered in this chapter are contribution margins and ratios and how they contribute to fixed costs and income. Chapter 19 focuses on variable costing by contrasting it to absorption costing. Absorption costing assumes that products absorb all costs incurred to produce them, including fixed overhead, whereas variable costing assesses fixed overhead as a period cost, not a product cost. This changes the per unit cost of goods, reflects the contribution margin, and can change the amount of net income reported in a period. In pricing special orders, managers should accept any orders whose price is greater than the variable cost associated, as only the variable costs change with volume and fixed costs will remain the same. Chapter 20 is about master budgets and performance planning. Management uses what it knows about cost behavior and their contribution margins to begin budgeting, which is the process used to formalize plans. Budgeting provides a basis for performance evaluation and should serve as a source of motivation. It should be done in a coordinated effort so that those involved understand and accept the budget. The formal plan for a company is called a master budget, and it will contain the plan for business operations and capital expenditures, as well as the financial results expected. From what we now know on master budgets, Chapter 21 teaches us about flexible budgets and standard costs. Fixed budgets focus on a single amount of sales or activity, whereas flexible budgets are based on several different amounts of sales. Flexible budgets offer more information for comparison to actual results. To better understand these variances within the flexible budget, standard costs, the normal costs that should be incurred, are identified and can then be examined for significant variances. Cost variances can be broken into price and quantity variances. Unit 1 focused on cost allocation by determining the types of costs, such as product or period, the activities involved, such as job order or process operations, and the chosen method of overhead allocation. From this, product costs are determined, prices can be set, and profit margins figured. Unit 2 focuses on cost behaviors and variances and uses the information to prepare budgets and evaluate performances. By analyzing the costs, we hope to learn to predict future behaviors and costs and profits. I'm Roy Bohannon, and this has been my video presentation for managerial accounting.